In the 1990s, dividend stocks had been on a major decline, but they made a roaring comeback following the dot-com bubble. Investors lost a lot of money in the dot-com bubble because everyone was investing in that shiny object in the corner even though there was no proof of performance. Hi everyone, Brian here. In today's video I plan to cover the top 13 dividend stock where you should consider adding them to your portfolio, where I do expect that they'll outperform T-bills and CDs over the next year. Granted, past performance is never a guarantee for future returns, but if a recession does hit us before the bull market kicks in, then these dividend stocks should give you a little bit of extra diversity to help minimize your risk. I am also not suggesting that you put all of your money into these stocks. I'm merely trying to provide you some options to help round out your portfolio. And just a quick reminder that qualified dividends are taxed at a rate between 0 to 20%, depending on your tax brackets, and they are significantly lower than income tax rates. But you also need to be aware that REITs do come with a higher tax burden because they often incur some capital gains distributions on a portion of the dividends due to selling some of their properties. For that reason, REITs are often better suited for non-taxable accounts like your 401k or your IRA. Don't get me wrong, they are still good for some added diversity, but I do want you to be aware that the taxes on REITs are slightly more complex than qualified dividends. I also want to ensure that you understand that dividends are not created to be paid out as a percent to the cost of a stock. Instead, a certain dollar amount is divvied out amongst every share held, and this payout is then called a dividend. Let's say that you own one share of Widget America that you purchased for exactly $100. At the end of the year, your stock price is still at $100. And the board of directors for Widget America chose to pay out a dividend of $5 to each share held by a shareholder. When you receive that $5 dividend, it equates to a 5% dividend yield, which is 5 divided by 100. In another example, let's say that your original $100 purchase a year ago had appreciated to $200 at the end of the year. And once again, the board of directors for Widget America pay out only $5 to each share held by each shareholder. It's the same payout as the other example as far as the dollar amount, but the only thing that changed was the share price at the end of the year. And in this instance, the dividend yield drops down to 2.5%. It's because there is an inverse relationship between the stock price and the dividend yield. And for that reason, you need to be cautious when you're looking at potential dividend stock. I get it. It's easy to look at a stock and then see that its dividend yields is, 10%. But it's not necessarily because they're paying more than any other stock. Instead, it could be because their stock price had completely tanked. If you walk away with anything from this video, please let it be that dividend yields as a percent have an inverse relationship with the stock price. And with that covered, I have a favor to ask of you. If you like my content, I would greatly appreciate it if you'd consider pressing that like button so that my channel here on YouTube has a chance to grow. I'd also greatly appreciate it if you'd consider subscribing to my channel so that you'd be up to date with all of my latest content. And with that covered, let's get onto the list of the top 13 dividend stock. I'm planning to list out the stock in the order of the lowest stock price performance to the highest stock price performance for 2022. This way it gives the listing a little bit more variety than simply the dividend yield. I also want to state that I'm only picking dividend stock that are above a 5% yield and that are companies that I believe are solid performers. Now there are some companies that pay out crazy high dividend yields, and it's not because they're healthy, it's because they want more investors to be pumping them with funds. And I am staying away from those Trojan horses. The first dividend stock reviewed is Haynes Brands with a dividend yield of 8.07%. Their 2022 performance was poor at just over a negative 61%, but their 2023 year-to-date is at 26.26%. I am not in love with their 2022 performance, but I see them as a bit of a sleeping giant, and their year-to-date numbers are already showing that comeback. Last year, this company was hit hard with supply chain issues, a cyber attack, and a major drop in demand. But I think that investors way overcorrected the stock price. Since I had managed a portion of men's apparel at Amazon, I know that Haynes Brands has a strong foothold with everyday basic low-cost apparel. And if we do have a recession, the low-cost brands like these tend to do very well. Haynes Brands has only been paying out a dividend for the past 9 years, but they have been very consistent, and their dividend payout is substantially higher than the consumer goods sector, which is only at 2.12%. Overall, I believe there's a lot of upside with Haynes Brands, and their dividend is very strong. And remember to keep in mind that if their stock price soars this year, then the dividend yield will probably go down if they keep the dividend dollar payout the same. Inverse relationship. The next dividend stock is Intel with a yield of 5.1%, and their 2022 stock performance was just over negative 48%. And for 2023, as of January 12th, they are up 12.94%. Intel has paid out a dividend for over 29 years, and I think that you can count on them to continue that trend moving forward. Intel certainly meets my dividend requirement of 5% or more, but this is one of the companies that I'm a bit on the fence with. Their performance in 2022 was bad, where they missed their top line sales by over 20% due to a major decrease in demand. And I'm trying to figure out, how does COVID play a role in that? As more companies allowed their workers to work from home, these companies probably put off upgrading their computers in the office. So does this mean that over the next 2 years that there's going to be a major increase in demand for PCs because workers are going back to the office? I don't know. I do believe that their stock price took a bigger hit than what their performance suggests, and that may mean an extra 10% of upside over and above the market. But that's only if their demand falls back into line. Like I said, I'm a bit on the fence with this one, but I'm going to invest a little bit just in case. Moving on to the next stock of Newell Brands with a dividend payout of 5.04%. Their 2022 performance was at a negative 40%, and year-to-date in 2023, they are at a positive 13%. In 2022, they wound up having excess inventory and debt that they had to refinance. That extra debt being refinanced hurts a lot because, as we all know, the rates have gone up, which means borrowing money has become a lot more expensive. But because their debt is due to heavy inventory, it means that they have direct access to free cash flow, meaning they're in control of that product, and if they want to gain cash flow, they can move it. In addition, with their Tupperware and Lifetime brands like KitchenAid, they are in a strong position going into the spring and a potential recession. Because in a recession or even high inflation, we eat out less. So that means we're going to have leftovers when we cook at home, and you're going to need Tupperware storage. The next stock to cover is New York Community Bank Corp with a dividend of 7.1%. And their 2022 performance of just over a negative 29% and a year-to-date of 8.14%. And most every investor in the community states that New York Community Bank Corp is highly undervalued. Not only is the 7% dividend a great point of revenue, but with the upside in the stock, there is a lot to gain by having them in your portfolio. They have been around since 1859 and recently acquired Flagstar Bank, which is known for My Banking Direct website that offers a high-yield checking account of 4.05%. Yes, you heard me correctly. That's higher than most CD rates. I will now move on to Verizon with a dividend of 6.6%. and their 2022 performance of just over negative 24% and a year-to-date of 4.52%. Verizon has been spending money like crazy to build out their 5G network, where they plan to cut back spending by around 24% going into 2024. Competition is fierce right now, but I believe that Verizon will follow suit with the S&P 500 growth, all while keeping their strong dividend. The next stock to cover is Spider's SYP Global Dividend ETF, with a dividend of 5.23% and the 2022 performance of just over negative 11% and a year-to-date of 3.41%. This exchange-traded fund, or ETF, is an index of 100 high-dividend stock across the global landscape, but they do not have more than 20 stock from any given country. Anyone who knows me knows that I'm a huge fan of index ETF, and this is by far one of the safest across the dividends that I'm discussing today. The one downside is the 0.4% expense ratio, but that is the trade-off for a little extra safety and diversity. Rounding off our dividend stock list is Dow Chemicals with a dividend of 5.35% and the 2022 performance of just over negative 11% and a year-to-date of 14.27%. I genuinely love this company because they've been around since 1897 and they thrive on innovation. I'm the first to admit that their branding is horrible, but as a company they have had solid results and their business model is sound along with their financials. You tend not to hear any crazy controversies coming out of the company because they focus on the fundamentals of business like they have for over 100 years. Not only did they outperform the S&P 500, but they had a great dividend of over 5%. The next stock to cover is LyondellBasell Industries with a dividend of 6.1%. and their 2022 performance was just over negative 9% and a year-to-date of 11.74%. This may not be a company name that you're familiar with, but they have dual headquarters in Houston and in the Netherlands. They are the world's third largest chemical manufacturer, and their predecessor companies have existed for over 70 years. But they've only been on the stock exchange since 2010. In addition to chemicals, they also make polymers, plastics, and they refine fuel. Our next company to review is WP Carey with a dividend of 5.1%. and the 2022 performance of just over -4%, and a year-to-date of 5.9%. W.P. Carey is a REIT that has been around for 50 years. And compared to the S&P 500, they had a great performance. Their top 10 tenants represent 18% of their annual rent payments, and they vary widely between DIY stores, self-storage, government space, and schools. And for the most part, those are all companies in areas that do very well with paying their rent. I like how their portfolio is diverse across several countries, but I also like that they have over 50 years of history to really keep them on track. And moving on to one of my favorite companies on our list is IBM, with a dividend of 5.4%, and their 2022 performance of 5.41%, and a year-to-date of 3.1%. And in case you're wondering what IBM stands for, it's International Business Machine, and they became a business in 1911. Today, they provide cloud and artificial intelligence solutions. They're also working to pioneer the hardware and software solutions necessary for quantum computing. This area of their business has tremendous upside, and given that the company far outperformed the markets last year, all while having a 5% dividend, this is an absolute must in my portfolio. IBM is one of those no-brainer stock where I think it would be a huge miss not to carry it. The next stock to cover is Philip Morris International, with a dividend of 5.3%, and their 2022 performance of just over 6%, and a year-to-date of 0.84%. Philip Morris is one of the oldest tobacco companies out there, at just over 176 years old, and they exist in over 180 countries. When I worked at Albertsons Corporate, which owns a chain of grocery stores, it became evident that there are a handful of products out there that are recession-proof. And at the top of that list happens to be alcohol and tobacco. This stock happens to be a perfect defensive move if we do hit into a deep recession, because it has a strong history of performance. Seeing as how my own mother passed away from lung cancer, I'm not going to get into the ethics of buying this stock. It clearly did better than all of the markets last year, and the dividend gives it every reason to be on this list in this video. Now I'll move on to the next stock of Kinder Morgan, with a dividend of 6.1%, and in 2022 their performance was 14%, and a year-to-date of 3.87%. Kinder Morgan is one of the largest energy infrastructure companies in all of North America. Our reliance on natural gas, CO2, oil, and gas won't be going away anytime soon. And our reliance on the infrastructure to move those products also will continue to expand, at least in the short term. Honestly, I can't name many companies that had a 14% growth last year with a 6% dividend. I can only state my remorse for not having more of this stock going into last year. And moving on to the last stock to cover today is Diamondback Energy, with a dividend of 9.1%, and their 2022 performance of just over 26%, and a year-to-date of 3.99%. It's no surprise that another energy stock happened to make the list, and it blew up last year with their performance. Diamondback Energy focuses primarily on acquiring onshore oil and natural gas in western Texas. Wall Street analysts have an average forecast on Diamondback Energy to be up 27% for 2023 and list it as a strong buy. Granted, there are no guarantees with forecast or analyst predictions, but if you layer on that forecast in conjunction with the dividend of just over 9%, I think we could all use a nice dose of those numbers after the beating we took last year. I hope that my list of top dividend stock gives you some much needed direction on some investment options going into 2023. Thanks so much for watching.